In this week's update, was that a bottom in gold? Has AI passed on the baton? And is the US market changing character, or is it just seasonal? My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is, of course, of a general nature only. What a week. If you think of all the volatility and all the headlines that we saw last week, it was quite an unexpected departure from where I was discussing things last Sunday. So what I said then was that we should expect significant volatility, and boy, did we get that. I also made the point that in the AI trade, strong demand needed economic proof, and we certainly saw some more of that theme starting to unfold as well. But along the way, we're increasingly seeing that these days there are plenty of false narratives. So you've got to do your homework, or you've got to be plugged into an information service that does the homework for you, because going off headlines is just so misleading. It's crazy. So there were a couple of curveballs on our journey to the middle of July when US earnings season starts, and it's going to be big. The results are going to be big, and we're going to have to look at them very scrupulously. The two curveballs were Meta and their supposed spare compute capacity. I'm not sure that we've really seen the full story there yet, because it's just being muddied by so many false narratives. And then the jobs report, again, was unexpected. And if anything, it put downward pressure on more US rate hikes. So that was a bit unexpected as well. So the market's just getting whacked from side to side with unexpected events at the moment, at a time when parts of it are seriously stretched, at a time when it's the lowest summer liquidity, and so that causes more abrupt price changes. It really is a recipe for what we saw last week, so there should be no surprise, and I don't know that you can draw much in the way of conclusions. For the last couple of years, there's been a whole bunch of people out there who are bearish on the AI trade. They're always ready to pounce on any headline at all and say, aha, now I'm right. But I don't think there's any evidence that that is the case. It's far from proven. And I think they're just doing what naturally comes when we have a bias in our mind, and that is they're seeing what they want to see. They finally got a bit of positive evidence. They've just been dying for this AI bull market to stop and reverse. That's probably because they didn't ever get on the train and they've been hating it the whole way. I don't know what the real reasons are. It doesn't matter. But for me, the erratic mess that we saw for a couple of days in AI stocks last week just really doesn't make much sense. We saw memory stocks absolutely smashed. And then Korean memory stocks on Friday rebounded sharply. And Meta, which was the cause of one of these factors, actually went up 10%. And other hyperscalers went up with it. Does that make any sense to anybody? The hyperscalers have been criticised for, a couple of years for over-investing. They'll never get an economic return on their investment. And then finally, we get supposedly what is evidence, and that is that Meta has got some spare capacity. So is the AI bubble finally bursting? But it goes up 10%. I can't make head or tail of that. So I think the interpretations that are being made in the market are just somewhat nonsense, and they smack of algorithms that are just pinging off the headlines. I'd like to bet my money that that's where the major trigger is. So we shouldn't ignore it, what happened, but equally, we shouldn't be overreacting to it either. We need more data. Profitable investors, this is my attitude, and I know it's not shared by everybody, but I just want to be consistently profitable. I want to know that my process, year after year, is going to deliver me the result that I want. And I don't really care whether I'm right or wrong on an individual stock basis. I can move on from a loss without a second's thought because I trust my process to deliver the outcome that I want. At the end of the day, we should all be here to make money, not to be right, not to be able to brag about the winners that we got. That's just crazy. We're here to make money, pure and simple. So for me, anything that is high probability is absolutely fine. As long as my portfolio is doing what I want it to at the end of a quarter or a year, then that's absolutely fine for me. We've got a very complex global mix of cross currents with wars and geopolitics and incredible leverage in the system. It really is huge. And one of the things that has arisen in the last very short period in Korea is the introduction of leveraged ETFs, which has brought in a whole bunch of speculators, probably a whole bunch of retail people that are very inexperienced. So you put leveraged ETFs together with that kind of mix and a very stretched market that's been running for a long time. And in Korea, they've got two of the memory giants of the world in SK Hynix and Samsung. And that's a pretty toxic mix. And then we've got the Fed, which is not what was expected at all. I think everyone assumed that Kevin Walsh would be quite dovish because that's what Trump has been screaming about for a couple of years to get Powell out of the job, but that's not what was expected. And he's come in with a harder line, meaning more rate hikes by the end of the year. But then, of course, that got watered down at the end of the week with the jobs data. So I don't think the market really has a clue what's going to happen between now and year end in terms of rate rises or rate cuts or nothing happening at all. The narrative is changing rapidly on rumours, on wild speculation about what's going on. And then all of that is just being misinterpreted by people who are seeing what they want to see. So it's not a week that we can really hang our hat on in terms of making conclusions. And of course, we've got summer liquidity is much lower. And we also had holidays in there as well. I'm sure some Americans took extended weekends. So you put all that together and it just means that markets can jump around and it doesn't actually mean a hell of a lot. And then sitting above all this, of course, we've got increasingly the role of algorithms in all this that are now controlling some incredible percentage of trading. There are suggestions that it's well above 50%. And of course, this isn't considered judgment. This is not a human being thinking about you put A with B with C and you get D. That's not happening at all. It's just algorithms that are programmed to instantly react to either buy or sell depending on certain headlines. And the final thing, which just all adds to this amazing mix of volatility, is that we've got this process that just has to run its course. ETFs wind up, more and more people pile into ETFs and it becomes a self-reinforcing spiral to the upside. And then a trigger when markets are really stretched to the upside and starts to unwind and it's forced selling. Again, it's not rational thought. It's not people thinking all these factors mean that the AI bubble has burst, therefore we'll sell. That's not the majority of it at all. And I think you can get a sense of that when you see trillion-dollar stocks like Micron or SK Hynix moving 10% up or down in a single session. And in the case of SK Hynix, it did it on back-to-back sessions. So 1 trillion market cap that fell 14.5% on Thursday and it rose 11% on Friday. It's quite extraordinary. So I think next week is really critical as far as the reality goes. Will there be follow-through buying from Friday? Or will it just mess around for a few weeks? I mean, the answers to that are completely unknowable. So was it a gross overreaction? Look, I think there's a good element of that, but I'm not pinning my hopes on that being the case and sticking my head in the ground and hoping that the AI bubble hasn't burst. We've got to look at the evidence. So what we're going to be watching very closely next week is obviously the reactions of those two memory giants in Korea. We'll be looking at the hyperscalers. I think how the hyperscalers behave next week will give us a bit of insight. The attitude of the market towards neocloud companies is also tied up with that whole mix. The US dollar and the gold sector is really important, but probably more important than all is the bond market. So that's our personal homework for next week. We'll be all over it, and we'll give you some interpretations in next Sunday's video. I've been saying this very regularly of late, and that is, as the volatility escalates, you just need to be more and more organised, and you need to not just drop into the market to make some money because it seems like there's some exciting things going on. You actually need to get organised, otherwise there's a very high probability you're going to lose money in this kind of market. It's just so volatile. So let's look at American stocks now. The S&P was up 1.75, the NASDAQ by 2.1. IMW was down a little bit. Now there was stepping back, forgetting the headlines, forgetting our biases and what we think should happen. There was no change in the character of the index, and we'll see that in a minute. And the breadth rose in many respects. Now there was some shift in SMH, in semiconductors, but at this point in time, it was just the lower liquidity consequences and this new dynamic in Korea, which is these leveraged ETFs on trillion-dollar stocks. Now, that only started a month or 6 weeks ago, and a whole lot of people have poured into that market and distorted it. So when you do that at a time of low liquidity, then I don't think you can place a lot of stock on just a few days of trading. So is the AI scarcity theme finished? Don't know. Certainly not going to ping off the headlines. The conclusion that I make at this point in time is that what happened in the American market last week was just a rotation. It's not a peak in the market for the market as a whole. So I would just not fret about it at all at this point in time. Let's see what the next week delivers. And the fact that the bond market did what it did is proof that it's just a rotation. And my view is that you stay with what is, you stay with existing momentum until that momentum changes, or until you are unequivocally proven wrong. It's guessing if you do the opposite. Just stop and think about it. It is. If you assume that something is going to happen because, A plus B equals C, then you're just guessing. You've got to wait until something that's been running so strongly for years actually gives you evidence that it's changed. So the US dollar was down a little bit, down under 101. The yield rose to almost 4.5, so the yield up, bonds being sold. If this was anything else other than a rotation, then you would have seen the yield go down. And this is the final one. The VIX fell really sharply. Last week we were 18 something, and now we're 15. That wouldn't have happened if this was a serious top in the market. Just no way. Let's look at some charts. So there's the SMH chart, ETF for semiconductors. It went down, and that's a bit of a nasty looking candle. And yes, the volumes were up in total. So there was some heavy selling here, no doubt. But it closed off the lows. And we closed off the lows through here as well. There are buyers willingly stepping in to buy the end of the day. You don't see that when it's a major reversal because the funds know and they are getting out of the way and they are selling all the way through. There were buyers here on Friday. So that kind of really takes the air out of it's a market top kind of narrative. It's a major AI top kind of narrative. There's the NASDAQ. So again, you can see not a lot at that level. This is important, consumer discretionary versus consumer staples. Nothing to see here, move along. This is the one I wanted. So the individual sector charts, XLK certainly came off. The S&P just went sideways, didn't do a lot. Energy didn't change much. Healthcare rose. So a bit of a strong week for healthcare. Consumer discretionary, consumer staples, no real change there, and so on down the line. We'll move on to Australia. Information technology still leading the pack as it has done for a few weeks now. We've seen some good rises. Materials rebounded very nicely. Small caps kind of holding their own. Then we've got the ASX 200. And then energy, positive for the week. Healthcare continues to recover from just being disastrously smashed. And at the bottom, we've now got energy. So healthcare and energy have kind of really flipped over in the last little bit, which is pretty much what you'd expect. There's the S&P, so nothing happening there. The Russell down slightly. And the RSP, so this is the equal weight S&P 500, so taking out the impact of the really large cap stocks. And it actually went up on the week, so nothing dramatic there. So I think anyone that was getting a bit fearful of what might be coming, I think you can just take a deep breath and relax, is pretty much the message. The Australian market, our dollar 69.3, just bouncing as the US dollar went down a bit. Our index made just under 1% for the week with materials, and healthcare in V-shaped rebound is pretty impressive, with CSL finally getting a bid and Pro Medicus continuing a really impressive bounce. And energy, of course, remains under pressure. Turning now to precious metals, gold rose 0.5% for the week to just under 4,100. And we're now getting back to levels that could prove to be resistance. They were support for a while, and they broke emphatically, and now we're bouncing back to them. So I'm not jumping into the pool with both feet when it comes to the gold sector just yet. Aussie dollars, 6,000. Silver rose 7.5% to 62. Look, there's a few green shoots. If you look at individual stocks in Australia on Friday, there were some nice bounces in producers, particularly in producers, but we really don't have the sort of bigger picture confirmation yet. Gold has got to do a lot of work yet. So don't get carried away because you saw a couple of spectacular green candles on Friday in the gold sector. It might be the bottom in gold and gold stocks, but it's far from proven. Now, if you've got more of a trader's mentality and you're going to use stops, then yeah, Friday might be a useful reversion point that you could use, but you'd want to put some tightish stops on them if that's what you do. Oh, this has got out of order, which is very annoying. I'll just put the whole slide up. Okay, so when it comes to gold stocks, in Australia, the producers far outperformed the metal for a couple of sessions. But what is the evidence that we're looking for? What do we need to see for the next major up leg? Not a rebound from oversold. They're two very different things. A rebound from oversold can be a trap, whereas the next major up leg is where you can build an extraordinary amount of wealth. So they're two very, very different things, and they've got different signals and different time frames. So I think for the next major up leg, I'm not interested in trading a short-term bounce that might last for a few days or a few weeks. I'm interested in the next major up leg. So for that to start, I think we need to see a significant correction in equities, and I've been talking about this for weeks and weeks now. The gold to SPX ratio. We need to see something more positive there. We've got dual earnings seasons coming up for American gold stocks and Australian gold stocks, and that'll be very telling. And I think you'll find that Australian gold producers, their results and their balance sheets and their outlook will be very, very strong, even though gold has come off more than 30% in the last few months. Inevitably, there will be some opportunities now. There'll be some stocks that will start to run. So I don't want to completely turn you off. But what I do want everyone to recognize is that you've got to be very clear about what you're doing. I don't think this is a time to buy anything on I'm buying this for the next 2 to 5 years. Well, I don't think that's wise at this point in time. But if you want to trade some things in the short term while all this unfolds, then yeah, go ahead. There's a basis for that because it's a structured transaction. It's not just set and forget. We're not at the set and forget kind of chart stage yet. So when we go to the charts and we have a look at, we'll start with silver. This is a daily chart. So it's had a nice couple of days. There was still selling on Thursday. Friday was a little more positive, but it's not a terribly big range candle. It's not like any of these. And before that, the week before that was just all indecision. Long tails, top and bottom. Nothing much happening. So for me, this is an oversold bounce at this point in time. That's all it is. Gold. This bull market started in March of 2024, so about 2 years and 3 months, and it's still a standard bull market. We haven't even come down to the 50% Fibonacci retracement yet. I am a little surprised and a little disappointed that it didn't stop here at the 38.2. That would have been, if it had stopped there and gone up, that would have been a real sign of strength, that buyers were willing to step up with only a more mild correction. But coming down to the 50 is no big deal, because that's pretty standard stuff in all kinds of markets, whether it be commodities or stocks or whatever it is. A retracement to the 50 is still a sign of a pretty strong market. Now, if we pull back to here, which is 34.70, it doesn't kill the bull market. It just means that this bull market is not as strong as what we thought it was back here. But the key point here is that we've got, and it doesn't show up too much on this weekly chart, I'll just put this on a daily. We've got plenty of resistance. So what was support here around 4,300? This is quite a key level through here at 4,300, picks up lots of tops and lows. So this, by rights, should become resistance. So that's why this can be a trap to try and think that we're now into a new bull market in gold and silver. And there's the gold versus S&P ratio. It's preliminary. It's nice. We've got a little bounce, but you can hardly say that that's definitive proof that we've now reached the bottom in gold and we're starting to move back up again. You just can't make that statement. Commodities, copper, 6.17. No change really in the narrative or the fundamentals around copper. Crude oil, 68.76. Is this a contrarian setup? I think for the short term, again, perhaps trading opportunity. We've gone down to long-term support. In fact, we went a little bit through it. Oil is grossly oversold on a technical shorter-term basis, so we could get a short-term bounce. So that would be more normal than no bounce. There's the spot copper chart, so not a lot happening there. Now, there's crude oil over the last little bit from February. So a little bit of a bounce towards the end of the week, but not much. But looking over 10 years, so we had a really, really strong spike with the war, which is exactly what you'd expect. And now that there are signs that the war is done, not sure I believe it yet, but we've now had the pullback that we had to have. So the final message, wrapping it all up, we're still really in the bigger picture position that we were in last Sunday. We've got a very uncertain 4 to 6 weeks ahead. So what should you do when things are more uncertain? Well, you should keep your hands in your pockets. You don't have to be buying and selling. You should only be buying and selling when you've got conviction, when you've got higher probabilities supporting the way that you want to go. Otherwise, to do a lot when everything's uncertain is just, you might as well go to the casino. So the probabilities are lower. We've got unclear or unproven outlooks, particularly around the AI trade. So maybe you want to raise a bit of cash because it's very frustrating when you get some great buys and you don't have any cash, but only from that point of view, not cash in terms of I'm fearful of what the market might do. I think just some prudent positioning. If you've got some really strong weightings, maybe some AI stocks that have gone up 300 or 400%, then, you might want to think about a bit of trimming of some of the profits. Just basic positioning, prudent positioning. Because at this point in time, we've still really got a continuation situation, particularly with AI and with gold. Because all incredible uptrends, as we saw with gold last year, and we've seen with AI for much longer than that, they have corrections. Every single stock, ETF, whatever you want to look at on the planet, will pull back 50% at least multiple times over a decade. So a very significant pullback is normal. There's nothing unusual about that. And until we've got much higher probability evidence, then you should treat a continuation situation as just that. Now, it's possible we're at a major inflection point for other sectors, like precious metals, for instance. But it was interesting that precious metals went up, but other commodities didn't. So pushing money into the market when the journey's unclear, I get to talk to a lot of investors who are entering the market for the first time on their own, under their own horsepower, or perhaps don't have a lot of experience. And it seems to be a theme that new investors want to just push the chips into the middle of the table, get their money on quickly, as though putting your money in the market is somehow going to produce a good result. It can actually produce a terrible result. So you just don't need to do it. You're never going to miss out. Get rid of the fear of missing out. You'll get poorer results if you succumb to that kind of emotion. So don't make any major adjustments to your portfolio until the pathway is clearer. Now, I think at this point in time, I'm thinking about the AI trade as a buy the dip. But I'm now more cautious about what dip I buy than I was a week ago. So I think you've got to demand deeper dips. That's just prudent when things are more uncertain. Distrust the headlines. You've got to look underneath. That's what we're doing. Seems like 18 hours a day. It's probably not that, but you've just really got to do your homework. So that's the final message for this week. There's more information on the website, and we've got a really effervescent group going at the moment. There's a lot of members who are doing their own research, which is adding to the collective. So things are looking very enthusiastic and very bullish for us towards the end of the year. So if anyone wants to come and join the group, by all means, I'll be back with you next Sunday. Cheers.